I thought I'd have to work till I was 70, he said. Yep, and then they hired your old buddy Josh, and I told him differently. Because we crunched some numbers and we looked at reality retirement planning. And we're going to dive into this number here, their stuff here. They gave me permission to use some of their stuff on Right Capital, the software I use. Obviously, you won't know who these people are, but these guys are crushing. And just like always, I always know, I can just tell if you're ready to retire. I can just ask you, what kind of cars do you drive? It's just that simple, man. Anyway, it's kind of fun because not only do they pay me to do financial planning for them, but they allow me to use there as a case study, which I post on YouTube, which I'll get paid from YouTube as well. What kind of upside down world do we live in? It's nuts. I get it, but I'm going to take advantage of it until there's somebody upstairs says no more, Josh. Until Zelensky drafts me to fight in his great army, the Zelensky army. All right, so check this out. So we got what we could call them. We call them Mary and Jane. No, Mary, that's two females because we're not 57 flavors here. We'll call them what do we call them? Bob and Jane. There we go. Bob and Jane. That's a good name. Bob and Jane. I should have said Tim and Jane. For some reason, that's easier to remember. No, let's say Bob and Jane. All right, so Bob and Jane. All right. Bob's going to be 67 at the end of this year. All right. Jane's going to be 63 at the end of this year. Bob would like to hang it up. He says, man, I'm ready to go. You know what I'm saying? Not quite sure when, but I'm ready to go. Bob said, no, my job is good, but it's stressful and it's wearing me out. And I'm not getting any younger. They don't have any kids. They do have a mortgage, actually. They only got about $500,000 of portfolio. They do have a mortgage, all right? Oh, my goodness, a mortgage. They have no car loans. That's critical. So the question is, can they do this? So let's just take a look. We're going to dive into their cash flows, and we're going to show you here. The answer is, of course, unequivocally yes. So what did I say? His name was Bob. We got Bob makes about $160, right? The spending right here is about $5,500 a month. That includes mortgage. Now, they're on their company plan for healthcare, so next year they won't be on the company plan for healthcare, so we'll talk about that. Bob will be on Medicare. Jane will have to go Obamacare. Anyway, so next year, so this year they're spending about $5,500 a month. That doesn't include the taxes they have to pay, and that also doesn't include the plan savings. So they got $159 coming in, they got $121 going out the door. That means they're stacking about $37,000 of cash money. 100%, that's what they should do. Now, next year, they got no income, though. I had them retiring at the beginning of next year, all right? Now, notice Bob is not taking Social Security. Why? Because Bob is 4 years older than Miss Jane, and we want her, because her benefit is lower than Bob's, to get the max benefit that she can get upon Bob's demise. So Bob will take Social Security when he's 70. Jane, we don't have her taking Social Security either, even on her own record, because she does have her own record, until she's 67. We're going to let them live off their portfolio until then. So next year, they got no money coming in. They still need about $5,500 a month, which includes a mortgage. Bob will be on Medicare. We're charging $500 a month for Bob's Medicare. Jane will be on Obamacare. We're charging $500 a month for Jane's Obamacare. Asterisk, we'll come back to that. So we got $1,000 a month for Medicare. They got about $2,000 a month for the mortgage, and they got about $3,000 a month, or a little bit less than $3,000 a month for spending money, if that makes sense. Now they might need a new car at some point, and a new to them car and whatnot. That's fine. But basically, they're living off $5,500 a month. All right. They have about $200,000 of equity, so they don't even have enough in which to do a reverse mortgage to pay off the mortgage. They don't have that. Now they can always downsize, but it's a cost to do that. So we're not doing any reverse mortgages here. No, even Bob asked, hey, should we? I said, no, I don't see the need for it. Now, they don't have kids. So reverse mortgage, you don't have kids, makes sense. But they don't have kids. But in this case, reverse mortgage doesn't make sense because they don't have enough equity to do reverse mortgage at this point. Now, if later on they downsize or something like that, they're not in a huge house. But if they sell their home, they could look and do that. A reverse mortgage for purchase, as we discussed. But right now, no need. So they're going to take $40,000 from Bob's IRA, all right? And they're still going to need about $30,000 to supplement their income because they need roughly $70,000 a year of income. $40,000 from the IRA, $30,000 from the cash accounts that they're saving. Or they could sell stock. They have a small, enough money in a brokerage account where they can have some capital gains. But because of the 12% tax bracket, the capital gain is all tax-free because they maintain their spending to the 12% tax bracket. So anyway, we're taking $30,000 out from a non-tax or post-tax account. They don't have any Roth, roughly, and they're taking $40,000 out from pre-tax. They're going to pay $1,200 in tax. That $40,000 from the Bob's IRA will give Jane the ability to qualify for Obamacare with significant premium discounts. We crunched some numbers off healthcare.gov for their county, and it costs about $1,900 a month for Obamacare. They're going to get $1,800 of that $1,900 premium tax credit. So it's going to cost her $150 a month. Now, the county that they live, they're only going to be able to get HMOs, which kind of stinks, but that, it is what it is. So they'll get that until they hit 65 each, and then Jane will go on Medicare, and we should see a little bit of jump in expenses. Yeah, small. So once they're on Medicare, Jane's costs will go up. Actually, that's not true because I'm still charging them $500 a month here, even for Jane's Obamacare, and another $500 a month for Bob's Medicare. So even though Jane will be less than $500 a month, I'm still charging them as if they're paying $500 a month for Obamacare. So that won't be much of a change. I'm inflating healthcare at 5.5%, by the way, just an FYI. I'm only inflating Social Security COLAs at 2.4. So now we got $5,500 a month. Jane will be on Medicare at this stage right here, all right? And we're taking $40,000 a year from Bob's portfolio, and they're only paying $1,200 in tax. All right, so now Jane's first full year of Social Security is going to be right here when she's 67 years old. Bob will have some Social Security as well, but his first full year won't be until then. All right, so when they're on Social Security, their first full year, they're going to have $73,000 of Social Security. We stop any distributions from IRAs. Why? Because they have $73,000 from Social Security, $72,000 of expenditures. They're netting $746. They got no taxes. Isn't that nuts? $73,000 of Social Security, $72,000 of expenditures. They're netting about $1,000, and they pay no income tax. You don't believe me? See, at 2024, this is before they're on Social Security. $40,000 of IRA distributions for old Bob, about $3,000 of taxable interest and ordinary qualified dividends. $45,000 is their total income because the rest is coming from their post-tax account. That means they qualify for Obamacare. They're not poverty-stricken where they qualify for Medicaid, but they're not too much income where they lose their Obamacare premium credits. $45,000 of income, $1,200 in taxes. Crazy, is it not? Yes, it is. Yes, it is. Let me show you what a tax for 2000 in the future years looks like. Here's 2033. Look at this. Social Security, $82,000 of Social Security, only $17,000 is subject to taxation. They're going to take mandatory distributions from an annuity that's got a variable annuity. They have no pension. They got mandatory distributions from an IRA, so $11,000 of RMDs plus $82,000 of Social Security plus some interest and plus some dividends. They're going to make, what is that? Freaking over 100, that's 82, 90, that's roughly $95,000 of income. But $82,000 of Social Security, only $17,000 subject to taxation. You get your standard deduction of $25,000, your personal exemption of $11,155. Yes, it does say QBI, qualified business income. It will revert back to personal exemptions come 2026 once the Trump tax bill goes away. Here's their total tax, a big fat zero. Here's their taxable income, a big fat zero. They're living off $90,000 of income. They pay no tax because the state of Georgia, they pay no tax either. If you're married, finally, well, it doesn't matter if you're married. Each person, once you're over 65 years old, gets $65,000 of tax-free income in the state of Georgia. Effective tax rate, look at this. Look at this. This is when they're on Social Security. Even with RMDs, effective tax rate is zero. Zero. Now they start getting a little bit of effective 4, 5. When Bob dies, their effective tax rate is what, 7%? And now when what do you call it, Mary? When Mary dies, it jumps up. You got an effective tax rate of about 12%. Yeah, well, she's going to have almost $100,000 of income. She's paying what, $13,000 of taxes at that point. You know, she's in her late 80s. What to do? Should they do Roth conversions? Maybe. Is it going to make a big difference? No. I wouldn't even mess with it, frankly. I just like, if they're not worried about Irma, there's no Irma issues here. Look at this. Why? I mean, we could do Roth conversions. That's not. They don't have any kids. Not going to accomplish anything. I mean, I guess you could say accomplish something to leave Mary less taxable income when she's in her late 80s. I just, who cares? Look at that. Look at that. And again, look, they're going to have $3 million of income, and they're only paying $185,000 in taxes over the course of their lives. And 33,000 of those taxes are coming while Bob is still working. So they'll have a little bit less than $3 million of income, $2.9 million of income, they'll pay $50,000 of taxes. So we take our choice of calculator, we say 150 divided by, I probably got to do this whole thing, divided by 3 million, roughly, 300,000, 3 million equals, their effective tax rate is 5%, dudes. Check this out. So here's a future. All right, this is her tax payment when she's a widow. She has $18,000 of taxes on $96,000 of income. About a 20% effective tax rate. Well, she's in her freaking late 80s. Who cares? So you can see, this is a perfect example of the widow's tax trap, though, by the way. And I don't make light of the widow's tax trap. I'm just saying this is how it works. But you saw, they don't hardly pay any taxes until Jane is a widow, elderly widow. Now, again, we don't know that Jane will be an elderly widow for only 4 years. She could be an elderly widow for a lot longer. I get you. We don't know. But Bob's actually pretty good shape. He bike rides. He's a musician. He's skinny. So it's not likely that Bob's going to go anytime soon. I just say enjoy it while you can, while the tax rates are low, while you're still young and can have fun, man. So check this out. All right, so here we got the widow's tax trap. So they made $154,000 between Bob and Jane. Their RMDs right here, Social Security. They paid $10,000 of taxes. When Bob dies, their income drops from 106 to 77,000, and Jane's taxes go up by 50%. And that sucks, man. I mean, there's no other way around. I'm not trying to make light of that, but in this case, it's just like the benefit of the low taxes on the front for the massive portion of the front end of retirement doesn't make Roth conversions make me all that amenable to it. And especially, by the way, they got to do Obamacare stuff anyway for the next couple of years. We can always revisit this when they're both on Social Security, but dudes. Anyway, so it's funny because Jane's the one who found my YouTube channel because she said to Bob, says, I think we're going to be all right. And Bob's like, really? And they saw this crazy guy on YouTube and said, yeah. Even with them, because they just don't spend that much, man. I just, it's your spending. When's the last time you looked at your budget? So I was telling about, I'm not going to have $1 million. I mean, I might have $1 million when I retire. I'll probably retire at 67 because this isn't a laborious job. I'm 53 next week. I got 14 years ahead of me. You know what I'm saying? I might have $1 million. I don't know. The trajectory is probably not. I don't have $1 million now. Nowhere close to it. You got tons of equity. You downsize. What happens when you downsize? Spending goes down. These guys are only paying less than $2,000 a year in property tax too. So no income tax, $2,000 a year property tax. Sales tax in Georgia is moderately low. That's where I live. Will I retire in Georgia? Probably not. Sales tax in Georgia. I mean, in Virginia, if I retire, I think it's a little bit higher. Property taxes are lower in Virginia for where I live than where I live now. Income tax will be negligible, as I just showed you there, because the bulk of my income would be Social Security. And then for me, it's all Roth IRAs. Unless I'm working still, if I have earned income, I'll pay tax. But the big tax hit for these guys, he's paying $33,000 a year in taxes on 160 of income, that's gone. The 20-odd thousand he's savings to his 401k, that's gone. So the whole point about this 80% rule is stupid too, because he's making 150. One second, let me show what I'm talking about. He's making 150. He's putting 55,000, 33,000, 55,000 divided by his 160 is what his income was. 34% of his income is going to taxes and savings. That's gone, dude. So if anything, we would look at Bob and say we just need a 66% replacement rate right out the gate. And by the way, he still has net income. He's still stacking another $35,000 of cash. Dudes, wake up. Wake up. Oh, but Social Security won't be there. Oh, you think they're going to reduce Social Security for millions of people? Are you freaking nuts? Are you nuts? Do you not know the thing called a social contract? You see what Macron's going through in France? On top of just raising the retirement age? You're not reducing it. They're going to raise taxes on these people have zero total tax anyway. Their taxes are zero. They have no taxable income to which raise the tax. They might raise it when she's a widow. I grant you, they could. She'll be in a 12% tax bracket, or whatever it will be at that point. They could. Do you really think they're going to raise taxes? You think politicians get elected by? Look, I get it. Elected, free and clear. What do they say? Free and safe elections here in Fulton County, Georgia. They don't live in Fulton County, Georgia. I'm just saying that's where I'm at, Fulton County, Georgia, and our elections are free and safe, or whatever it is. Do you really think that they're going to raise taxes on widows or in a 12% tax bracket? I mean, you could think that's okay. I disagree adamantly, but it's up to you. But at the end of the day, it's all about your expenses. Know your expenses. Know when you can retire. It's just that simple. All right. If you like these videos and you want to buy me a cup of coffee, right there in the doobie-doo, decaf, baby. If you want to buy me 5 cups of coffee, I'll drink them all right now. In fact, I'm going to go make a cup of decaf. And of course, if you want to sign up for my email list, go ahead and sign up for the email list. I emailed twice, once yesterday and once today. I typically don't do it every day, but sometimes I get a hankering, I'll start emailing. But if you want to be on my email list, sign up down below. All right, love your thoughts. We'll see you.